everyone. Today I wanted to go over what would be considered a high probability order block. And I made a list of the rules that you would basically be using to validate the order block for you to be more confident in the trade that you'll take from the setup. But what are the things that would not validate an order block? Um, if you're going to be looking at a point of interest, and you're noticing that liquidity, depending on the direction that you're going to be trading in, you notice that there's liquidity resting either just above, or just below the order block. You can reasonably expect that price will reach for the liquidity that is resting either above or below. If there are imbalances above or below, you can also reasonably expect that price will reach for at least 50% of the imbalance, which is resting either above or below the order block. So right away, that would negate the order block. So those are two clear points or things that you can look for in helping you to go by process of elimination per se. So if you see those two already, then you know that that invalidates the order block. If we're going to be looking at what would cause an order block to be valid, then it would be these rules listed here. So you're going to be looking for a purge of liquidity, whether it's at an old high or an old low, or even if it's a new high, new low that has liquidity resting above it, just a previous higher low. Look for where liquidity is resting and look for a draw on that liquidity that has created the order block. When price creates the order block, you're going to be looking for an impulsive move going away from the order block, and that impulsive move would be leaving imbalance, and it would also create a break of market structure. When price is going to be returning to the order block, price is going to gradually return to the order block. There will be a lot of manipulation in the return to the order block, which would engineer liquidity, and that liquidity would be purged on the way back to the order block. At the order block, mitigation would occur, and then price would reverse away in the other direction. In that direction, now you're going to be looking for, in terms of a target for take profit, you're going to be looking for more resting liquidity, and that's where your target would be, at least whether it's you're doing partials, so whether it's going to be the first target, second, or whatever the case might be. That's how you would basically draw confluence to validate the order block. So you're going to be looking for, just to repeat, the purge of the liquidity, the impulsive move away from the area, leaving the imbalance, breaking structure. On the return, price is going to gradually return, not return so fast. It's going to engineer liquidity. That liquidity would be drawn on, mitigating the order block, then reversing in the other direction where liquidity should also be resting, because that's where price would be heading next. So to show you examples, an example on the chart or two, let me remove this. Right, so one quick look, we can see that there was a huge purge of liquidity here. So that candle went through this entire area. So all of this internal range liquidity was drawn on. And so we were gonna mark out this candle, the wick. It's a huge wick. So I'm expecting price to come back to that wick. Right, just wick to right into the wick there. Okay. Yeah, so looking for the confluences. Price went into the area, cleared liquidity, then left it quite impulsively away from the order block, broke structure here. Remember, this is the 1 hour time frame, so this is key structure. It's a higher time frame structure. Then price gradually went back to, you didn't see this kind of impulsive move going back to the order block. And what it did on the way back, it engineered liquidity. So it engineered it here and then cleared it with this candle and then did the same thing again up here and then went into the order block, the point of interest. So, and then left. And what it did under here now would have been where it would have cleared liquidity again, because liquidity would have been engineered on the way, all the way throughout. So you'd be looking at this area as a target. So just to go over that quickly, the order block was created, or the institutional candle that created the drawn liquidity is the order block and or the point of interest. With that point of interest, we're looking for an impulsive move which leaves imbalance on the way, leaving the order block. So price moves very quickly away from the area. It breaks market structure, and in returning to the order block, price gradually returns there, engineering liquidity at the same time clearing it, and when it mitigates the order block here, it then moves away and clears liquidity again. So that would be your area of interest in terms of a target. Let's find another one. Okay. This is an order block. This is a, all right. So we noticed that liquidity was drawn on here. We then see the impulsive move away from the order block, and we see where a structure was broken here. Right. What would have the type of order block that is in this scenario is a breaker block. And so looking at that, let's highlight it. That's a huge area. Obviously, we would have to go down to a lower time frame and refine this entry. But yeah, so we had the drawn liquidity, the break of structure, price did its thing and it's maneuvering, and then so let's show you the points where all of this internal range liquidity was created here. Sorry, all of this here. So all of that was created and then purged, and then the order block mitigated. Price then took off and went on its merry way, and that would have been a very good trade again. So, sorry. Once you get the concept right in terms of the confluences that you are looking for to validate the block and make it a high probability order block, then the chances are that you'll have a very good trade setup. Obviously, there's nothing guaranteed in these setups because price can do whatever it wants, and the truth is the market makers control the market and they control the way price moves. And so these are just guidelines per se to say, okay, if we follow steps 1, 2, 3 to 5, then the probability is that this should happen and this should be the outcome. And it's based on those reasonable expectations that we are going to be risking our capital and entering into trades. What I can do in the next video is show you how to refine those points of entry so that you can get better risk to reward ratio in terms of your profits, and how you can uh, just basically get sniper entries in a sense, and get better entries where it regards to your returns. I hope this was clear. I hope this was useful. I hope you actually learned something from this if you didn't know much about what to look for in terms of getting a better entry and getting a better setup and having a valid order block. and I hope to bring more valuable content to you in the near future. I think I'll bring the refinement video sometime later this week and just get this series done and move on to another one. Thanks for watching and have a great day. Take care.